Today I will be discussing how I got an APV of 658.87 for the year 2014. So something I had to pay attention to was the revenue, the operating income, and the net income. And as you can see, in 2009, the forecast revenue was at 245.75, the operating income was at 22.60, and the net income was at 13.56. And then the current year of 2014 is at 331.26, and the operating income is at 41.57, and the net income is at 24.94. And now if we look down at the divisional reports, you can see that the revenue by division, most of my money is coming from production at 243.22. And then for the operating profit by division, my cash is coming from licensing at 22.07. And for the total assets by division, my money is coming from production at 201.37. So now I will show you the process of how I reached an APV of 658.87. And to explain this, I will show you the projects I invested in. So as you can see right here under the project updates, you can see both of the projects that I invested in the year 2014. And one of the projects was called Dollhouses with Miniature Dolls. And it says, this project launched successfully, but with somewhat lower margins than expected, attributable to higher production and marketing costs. Then the other project that I invested in was the Young Authors book series. And this one states that Best of Girls books were an immediate success with the targeted demographic. Both revenue and profit levels exceeded expectations. So now if I click here to view all updates, I can view all of the projects that I have used and invested in since the year 2009. So basically each year you can invest into a different project, but you want to make sure that the investments you make are positive. And by doing that, there are a couple different things that you want to look at called the NPV, which stands for net present value, the IRR, which is the internal rate of return, the PP, standing for payback period, and the PI, which stands for profitability index. So I'll explain a little on what those mean. The NPV is the difference between present value of cash inflows and present value of cash outflows. When looking at the NPV, the higher the number, the better. And the next thing you'll look for is the IRR, which is the true annual percentage rate of return based on the estimated cash flows. And next is the payback period, and that's the amount of time required for the net cash flows to recover the net investment. And for that one, the smaller the number, the better. And then lastly, we have the PI, which shows the relationship between the costs and benefits. And when you see a PI of 1, it means that you get what you want. And if you have a PI greater than 1, you get what you want plus more. So for example, for making decisions with a mutually exclusive project, all acceptable projects need to be ranked, but only with the best project accepted. The project with the highest NPV is expected to increase value of the company the most, and this is the same with the PI and the IRR for most of the time. So now I'm going to go to the project details tab. One thing I'll show you is that the cash flows, so for the cash flow statements, this is going to show the net income plus depreciation, which means what you're going to lose in value over time. So once those two are added together, you can see right here that there's a total of 0.84. And you can see that each year it increases. And So this is a good thing that it is increasing each year, so you can have a positive cash flow. So this will be better for you in the long run. If you see that your cash flows each year are the same or they're decreasing, you want to stop what you're doing because that could end on a negative note for your company. So now we're going to look at the income statement. So as you can see on here, we'll look at the the net sales, and the net sales decreased by cost of goods sold is going to give you the gross profit. As you can see, each year the gross profit is also increasing. It starts at 225.49, and then it ends up at 451.61. Something else that's increasing is the earnings before income taxes. It starts at 41.57, and over here it's all the way at 113.14. And then your net income is also increasing, starting at 24.94 and ending at 67.88, which that will be positive for your company. So now we're going to look at the balance sheet, and at the balance sheet is where at any given date, it's basically a snapshot that shows what you possess and what you need to repay, with the difference being your net worth. So on the balance sheet, you can see that we have assets, liabilities, and then down here we have the total liabilities and shareholders' equity. So an asset is something that is tangible or intangible that can be owned. And if you look right here, you can see that it starts, that the total net assets start at 311.60, and then they increase all the way to 453.37. So that's very positive that your assets are increasing each year. Also, so next we have a liability, and that's basically something that you owe. And looking here, you can also see that it goes up each year. Your total current liabilities increase, as well as the total liabilities and shareholders' equity, starting at 311.60 and then ending up at 453.37 over here. So basically, capital budgeting is important because it basically creates accountability. A company is able to search through new investment projects, such as the projects that I've chosen throughout the year 2009 to 2014. They're able to search through these investment projects and estimate their future cash flows. The companies need to make smart and positive decisions when investing in these projects, just for the sake of their company in the future. So just remember, when you're going through capital budgeting, that you always want to go back to the dashboard and look at your divisional reports to see where your money's coming from, and also always be sure to check the revenue, operating income, and net income to make sure that it is increasing.